What's going on, y'all? Welcome back to the channel, Wealth Hacker Labs. I'm your host, Jeff Rose. Got another edition of One Take. Market didn't really have a lot of craziness today, so I really want to spend some time focusing on a question that I get a lot, a concern that I get a lot, and chances are you have this concern. You have a family member, a coworker that is concerned, and that has to do with their 401k. The common question I get is, Jeff, do I need to cash out of my 401k? Do I need to stop contributing to my 401k? And chances are you are asking this question or you are concerned about this is because your 401k feels like it's done this. It's probably cut in half, and I get it. And many of you have not been here before. For many of you, this is your first experience with a bear market, with a financial crisis, and it ain't fun. Like, I know it ain't fun. It's not fun going through it. This is the third one I've been through. They're not fun, but there is a light at the end of the tunnel, and I just wanted to reassure you of that. But I want to spend some time just to give you some real life numbers, just to show you why that I'm saying stay the course and not cash out, why everyone else hopefully is giving you that exact same type of information. So let's go ahead and go to the computer real quick and take a look. First off, if you need any information on the 401k, complete plug though, this is my blog, goodfinancialsense.com. We've got anything and everything you need to know about your 401k. But right now, if you go into Google and type in 401k, like these were just some of the headlines that I saw pop up just today. So this is on Market Watch, and it's saying, don't look at your 401k. You know, like, no, I don't want to see. And if you know that if you suffer from anxiety, then okay, maybe don't look at your 401k, but you don't want to you don't be like a turtle and put your head in the shell. Like, I mean, I want you to know what's going on. Like, this is one of those times, like, I want you to feel it. I want you to experience it and embrace it, because this is going to be such a awesome learning experience when this happens again, and you can tell other people that are wanting to cash out, like, nope, don't cash out. And this is why, because this is what was going on. You remember the coronavirus, right? Remember back in the day? And this is what happened to my 401k, and here's what it was, here's what it dropped to, and here's where I'm at today. So don't like this advice of not looking at your 401k. And here's just another article talking about 401k take a hit, don't panic, and don't touch your account. I don't know who this economist is, but yes, I totally agree with this economist. Don't touch it, don't panic. And let me give you some numbers why. But chances are though, I don't care if you know this already, you still can't help but cry a little bit. You know, he got the crying Jordan meme there. So I know, it's sad. I get it. But I promise you it's going to come around. All right, we're going to go to this site. So this site is called Portfolio Visualizer. Someone else recommended this site to me. I used to have access to all these different investment tools back when I was a practicing advisor. Unfortunately, don't have access to all those now. So this was the best that I could find. This is a free site, so feel free to plug and play if you want. So what I'm doing here, we are doing a back test on a portfolio, and I'll tell you what we're using here in one sec. So here's what we are assuming. We are going back to 2008, the beginning of 2008, which was the last financial crisis. We are going to put in $1,000 in the beginning of the year. So this is like right before everything just goes crazy back then. We're gonna write it out until the end of 2019, $1,000, and we are putting this into ticker symbol SPY, which is the Spider's S&P 500 ETF. So this just represents the S&P 500. If you don't know what that is the top 500 US corporations that exist. So we're getting a good broad representation of the markets. All right, so that's what we are buying. This is the ETF that you can purchase anywhere, everywhere, and that is what we're doing. So we put $1,000 in, beginning of 2008, wrote it out to 2019, and then what happens? So our $1,000 is worth, at the end of that period, $2,817. We almost tripled our money in that time frame. Our rate of return there is just over 9%, which is like, okay, awesome, great. But like, that still doesn't really help me in what you're talking about, you know, with the market tanking and what that actually means. So what I want to show is, does it do? let me see, annual returns. All right, here we go. So check this out. So imagine you're putting $1,000 in at the beginning of 2008. By the end of the year, you have $632. $632. You lost almost $400 in a year. Not very exciting. 2009 was an awesome turnaround. We were up 26%. Like, that's a huge year. Obviously, you lost 36% the year before. Nonetheless, though, let's focus on a positive. You're still up 26%. Awesome. Or you're not even back to where you started. You start off with 1,000, you drop down to 632, now you're at 799. That's not all that exciting. By the end of the third year, 2010, now we're up to 919, so we're still not there yet. Year 5, 936 after making 15% and then a modest 1.89. And then finally, by the end of 2012, we're back to 1,086. We're above where we started. So 1, 2, 3, 4, at the end of the 5th year is where we finally get back there. Now for many, like that's not exciting. Like, here it is. I mean, it's 2020. So Jeff, what you're telling me, by 2025 is when I'm going to be made whole? Well, it depends on where you're at. Like, if you are no longer adding to your 401k, adding to your investments, then like this is what it looks like. But if you are able to add more to it, well, we'll get to that here in a second. But here you can see, and this is where compounding interest takes place. So 1,086, and by the end of this 12-year period, you're up to $2,817. We almost tripled our money. But as you can see, a lot of that happened in the last 3 years. And typically when you're looking at compounding interest, all that really doesn't happen until later on. But many people don't make it to there because it's here. It's right now is when people get freaked out. And that's what I'm trying to prevent you from doing. So this is looking at, we're just putting in a one-time investment. We're not adding to it. And this is what it looks like. All right, so what happens if we are adding to it? Which most of you, if you are working, if you have some income, you got your 401k, you can do a Roth IRA, maybe your company has a match, so they're adding money on top of it. So we're using a similar example, still beginning of 2008, going till 2019, we're starting off with the same amount, $1,000, and we're making one small change. And that change is that we are adding $100, and then we are doing that on a monthly basis. So $100 added every month. If you want to do the math, that's $1,200 a year that we are adding for that 12-year period. So what happens then? Well, check this out. So our $1,000 starting balance is now worth $39,279. So you put $1,000 in, you're adding $1,200 a year for 12 years. So you've added 14,000 plus of your own money. So about 15,000, including your starting. So let's just say, call it 15,000. You've more than doubled your money. Like, so this is what we're talking about right here. Like, this is what that looks like. And that's if you are adding $100 a month. So imagine if you're doing 150 a month, 200 a month, 300 a month, 500 a month. Like, that's where it starts getting really exciting. And once again, let's show you some of the breakdown. Oh, rate of return, same thing there, looking at 9%. Let's look at the annual returns. So you start with 1,000, you're putting in the 1,200. Like, okay, well, you're still down from what you put in, down that 36%. But once again, that's where you can see the money start growing. 1,500, 3,400, 5,400. So it doesn't hurt as much when you're adding more to it. But if you just stop investing, if you just stop putting in, like, it just gets that much harder. Now I'm using smaller amounts here. We're starting off with $1,000 in each scenario. I went online and looked at the average 401k balance by age. This is provided to us by Bankrate. And most of the people that are watching my channel right now are between the ages of 20 and 39. So we've got a average 401k balance here of 13,200 or a little bigger, 46,000. So I'm just gonna go ahead and let's do this together. So I use $19,000. So here, imagine like you've got and I guess you don't have to imagine this because you've probably already experienced this. Let's say you had $19,000 in your 401k before all of this happened, or going back to 2008 before all of that happened. By the end of the year, your balance, you would have $12,000 left. So you're down $7,000. Chances are you're watching this, you've already experienced this. And if you're one of my Gen X baby boomers watching this, then you've experienced this and and then some. So now let's just go ahead and change this up. So let's go ahead and do the cash flow. So we're going to contribute a fixed amount. We're going to do $100 a month, just like before, but obviously we're starting with a bigger amount. And let's analyze that. And that didn't do anything, because I didn't change the year. So let's go ahead and change the year to end year 2019 and analyze that. This should be hopefully a much bigger number. Otherwise, it's just, this video is complete bomb. There we go. All right, so now 19,000. Start off with 19,000. It grew to 89,000, almost $90,000 just by adding $100 a month. And that's what it looks like. But it's just, you can't even see like this dip right here. I'm gonna like enlarge this, but like this right here, when you put this out 12 years, like that looks like it's nothing. It looks like a speed bump, or maybe a larger pothole, but nonetheless. But when you start seeing the increase here, like it's an afterthought. But I'm telling you right now, like when you are in the middle of the noise, which that's where we are right now. Like this is where we are right now. That is where we are right now. Like that's what it feels like. And it's a scary place. It's a lonely place. And this is when many people just can't take it. They can't stand to see another negative. They just want to cash out and be done with it. It's the biggest mistake you will make. And this is why. It will literally cost you. This is over a 12-year period. If you are in your 30s, if I added an extra 10 years here, it'd blow your mind. If I actually add another 20 years here, your mind continues to be blown. But that doesn't happen if you cash out, if you quit. Don't quit, stay the course. If you got any more questions on this, I'm happy to help. If you found any value out of this, if you know somebody that just is on that verge of cashing out, like they just can't take it anymore, please share this video with them. Please share this so that they can learn. I want to make sure that I continue to help people build and grow wealth, but you can't grow wealth if you're sitting on cash, sitting on the sidelines. This is how you get rich, is by just staying in when the time gets rough. All right, y'all, this is Jeff Rose from Wealth Hacker Labs, reminding you that it's your money, your life, and only you can make it awesome. Till tomorrow, peace.